Wisdom is a big word. It's a hard thing to sort of learn, absorb. It's osmosis and experience that causes you to, I suppose, acquire some ideas. I use the word baggage not in a disparaging sense, but rather it's a collection, the summation of experiences that you've had over the years. The first person I encountered who was and still is very, very influential in guiding my thinking, has sort of been very formative in my thinking. It still sort of guides the way I think about investments and investable ideas generally, is Marty Whitman. My first encounter with Marty happened by reading his book in 1979. The book was the original edition of The Aggressive Conservative Investor. I cannot say the book is a literary masterpiece. In fact, I think it is a masterpiece of turgid prose. But I think it's a brilliant book. It's a book which, if read carefully, if the lessons assimilated, I think has a lot to say. There can be a lot that's learned from it. Clearly, to read the book, enjoy the book, and assimilate it, one has to be a willing participant in the exercise. As I said before, it's not an easy book to read. The first time I read the book was read before I went to business school. I had no background in accounting, so it was a bit obscure, the terminology a bit opaque, and I said it's turgid prose. So it's tough going, but it's a very readable book. Fast forward, go to business school, learn about accounting. I wind up in a school which is very focused on modern capital markets. It's a very much, I suppose, a school that spawned many quants in this world. It's the University of Chicago's business school. It was in the days when efficient markets reigned supreme, and that's what you learned, because that was the truth. Oddly enough, that was completely at odds with what I'd read in the book. So upon returning from that university and this wonderful education that I had, it's a fine school, but the education, certainly when it came to finance, was very much at odds with what I'd read in this book, which I thought was actually quite interesting. Rereading the book, you sort of knew this was it. The thing about the book, and broadly speaking, the investment philosophy articulated in the book, and it's a very straightforward thing. It revolves around two or three distinct components. One, you buy things, investments that are worth doing are things that are cheap in the here and now. Two, you're buying pieces of businesses, and these are businesses, yours is a pro rata portion of a business. And three, when you think about valuation, think conservatively. And four, avoid risk. Any risk to the business. The risk that is paramount is business risk, financial risk pertaining to the business itself, as distinct from market risk and generally day-to-day stock price volatility. So that was the initial lesson learned from that book. Subsequently, I had a chance to actually work with Marty starting in 1990. Again, lessons that I learned are typical from the contexts. I derived from living in Canada, kind of a rube into the big city in New York, and the first thing we encountered was a crisis in the high-yield debt market. If you think back to 1990, that was post the big year of Drexel. There was lots of junk debt, and parenthetically, not as junky as the stuff that makes the rounds these days in 2015 and 16, but enormous, then prodigious quantities of high-yielding debt that was jammed in insurance companies, in mutual funds, and all sorts of vehicles where it probably was inappropriate. What happened at that point in time to precipitate a crisis was twofold. One, the insurance commissioners promulgated a different classification system of debt, debt quality, as opposed to not being just investment grade and non-investment grade. They had 6 different categorizations of debt, and there were different capital charges to be taken against it. Very rapidly, insurance companies found that they had to do something to their balance sheets. Very rapidly, otherwise they run afoul of the regulators' requirements. That presented an enormous opportunity for us. I'd never ever studied insurance companies before, so this was a first. There came the first lesson. Opportunities come to you. You respond to them. And to this day, this is a very big thing. I mean, I always ask my colleagues, my younger colleagues especially, stay hungry. You don't know where your next meal is coming from, because this is an investment style that's ultimately very opportunistic. It involves responding to opportunities when they occur. And you have to adapt, learn, and learn lots fast. So there's an intense amount of focus on being swift at responding and learning about these things, but also being intellectually very flexible. So that was the first set of lessons. A lot of these companies in the insurance space got troubled. Companies that relied on financing, commercial real estate got troubled. So there was a whole class of opportunities that you wound up learning about. You also learned about how to think about risk as it pertained to insurance companies and financial companies generally. What would result in a permanent loss of capital, and how you would strive to avoid those things. That's a sort of pretty important thing, because typically the kinds of companies that meet our valuations, something has happened. Something bad has happened either to the company itself, to the industry, or even there's a much larger sort of capital markets related thing. I mean, this is a kind of lesson that keeps recurring again and again. This is a kind of situation, a class of opportunities that typically recur again and again and again. So subsequently, the opportunity occurred for me to go out and set up a fund, investing in non-US securities. Historically, it was not possible at Third Avenue, because Third Avenue is very, very much a domestic shop, and Marty was particularly disinterested in doing anything outside the United States at that point in time. So we set up a fund which was going to do exactly what I'd learned at Marty's shop, Third Avenue, but applied around the world. The fund itself started in 1996. It was not a bad year. I mean, it was a fine year to start a fund. Then came 97, which, if you're investing outside the United States, you would remember was the onset of the Asian crisis. Now, I had never encountered something of that size and scale, because the operating assumption everybody made if you invest in the United States, which is the way I was sort of brought up at Third Avenue, was capital markets sort of function. Things will get cheaper. There's always going to be a price for credit, but it'll always be available. In Asia, at that point in time, it was an enormous mess that unfolded. The mess which in part stemmed from prodigious amount of real estate lending that had gone in the respective markets, as well as the banks themselves, the financial institutions, borrowing in foreign currencies, namely the US dollar, and the currencies themselves, the local currencies being pegged to the US dollar, so of course it was always cheaper to borrow in US dollars, and lending it on to the locals. Now the problem was the currencies became overvalued as the US dollar kept appreciating. Upshot, the currency links were severed. Suddenly the liabilities blossomed. And of course you had this enormous crisis that started in 97 in Thailand, and then in 1998 Asia felt like it was being sucked into a black hole. This was a great, great opportunity. You saw it starting in 97, and you really didn't have an idea as to how far this would go, because if you looked across the landscape in Asia, you saw it was not just Thailand that was doing it. You saw the same stuff going on in Malaysia. You saw the same sort of stuff going on in other parts of Asia, so Philippines for that matter. And again, to different degrees. And of course, Japan at that time was sort of plodding on, kind of a basket case since 1990, in different degrees of pain. But you saw the thing sweep across all of Asia. The path was very simple. Investing was very, very simple in my mind. In my mind, the opportunity was, I think, very easy. On one hand, the currency had all collapsed. So things there were down 50, 60, 70, 80% in US dollar terms. You started to find opportunities, interesting opportunities, which were not in the companies that were exporters. The first response most investors had, well, the local currency's gone down, let's buy the exporters. That's kind of, I don't want to call it trite or dull. That's not a very interesting idea. Quite simply because A, it's obvious. That's the first. That's one of my craziness. We like to think in terms of what's my value add. If it's so obvious to everybody, what am I doing that's worth anything to anybody to invest with me? So what we wanted to do was we want to buy companies that were A, extremely well capitalized, because you want to make sure the company is going to be around for a long time. 2, we had been cheapened because of this crisis. 3, ideally, it was going to be something that was going to be in a local currency. So we started to look for companies that were shall we say, focused on the local market, in that their assets were local currency denominated, their liabilities were local currency denominated, so you didn't have the currency mismatch, which was killing the banks and killing all the other people. And you wound up with a collection of, you would be, surprise, surprise, many financial companies and consumer products companies. And many of them were extremely, extremely cheap. And that's how that fund began its life. We started in 1996 and 97. The opportunity began to present itself in these companies, first in Thailand, then pretty much all across Asia, be it in Singapore, Indonesia, Malaysia, Japan, Taiwan, and so forth. Lesson one, buy pristine balance sheets. If you're preparing for some really bad times, as we usually are, because we don't know what sort of anvil is going to be dropped on our head tomorrow. We can hope for the best, hope there's going to be no anvil hanging over our head, but you don't know where these things come from. So the irony was, we were down briefly in 1998, and for the stuff that we bought during that time period, we did extremely well with those same investments. We don't trade very much. I'm a very bad trader. We did well in 99, 2000, 2001, 2002, 2003. So we basically feasted for a number of years on those investments that were made in 1998. To be clear, 1998 was a very unpleasant year. If you have a very small fund, you're just starting out, and your early track record looks like it's going to be a terrible down year. It didn't turn out to be a terrible down. It was a down year. But again, what happened from there was we had a number of wonderful years that followed. So, moral of that story, I suppose, which continues this very day for us, is you really make money when you buy the stock. If you buy something correctly, this is not just the price, but the kind of company the business that you buy. If you buy correctly, you buy the right kind of company, the right kind of business at the right kind of price, and you are very careful about your pricing, and you've done it right, and if you are a long-term investor, you could do pretty decently for long periods of time. There were things that we acquired in 1998, which we finally sold in 2014 when that fund was wound up. We did extremely well in those investments, quite simply because of being there, being present on the day. It was available at a good price. Having done our homework, which is the other element of the lesson that was learned, was you prepare for these things. You learn about things. You think about them usually in a quiet place, not with the noise and hubbub going on in the market that you've got to trade. You don't have to trade. You don't have to do anything. You can sit for days on end and not trade and not do anything. I think Guy Spear and Manish Pabrai have, I think, a very, very apt saying that, the best trades are those that are done when the market's closed. So you do your work. And in many cases, that sort of was another element of our philosophy. We look at lots of things. We look at lots and lots of things. In many cases, we love to own them, but at a certain price. And the preparedness, should the option present itself, we are ready. Many times the option doesn't present itself. So the work is, to someone's mind, is, you wasted your time. I don't think so. Because the things that you're prepared for and you're ready to go on, to the extent you execute correctly on those things, I think far, far, far outweighs these sort of lost investment opportunities that do not occur, notwithstanding your preparation. So, there were a number of things here. One was buying things that were, these again were lessons that were internalized based on the experience itself, but very importantly, they flowed from the earlier days of Third Avenue. So I returned to Third Avenue in 1999, a small fund in tow. Third Avenue was a much bigger, flourishing organization, which was now investing outside the US. So it was a very different organization than the one I'd left, which was very US-centric. I returned with a small fund in tow, and a couple of years later, we started up a larger mutual fund. Now, again, organizations, I don't want to say organizations dictate investment methodology. I think in my ideal world, investment methodologies build an organization. And to the extent the organization stays true to its investment philosophy, I think the organization is a richer thing because of it, and a longer, more sustained entity. The organization grew. The philosophy that was the investment philosophy, I don't want to say morphed, people got older. With the passage of time, and Marty, when I first joined the organization, was 65. This is in 1990. And now we're talking the 2000s, a decade plus has passed. It's a larger organization running mutual funds, principally mutual funds. As people get older, the nature, I suppose, how they evolve to some degree mirrors their age, their net worth at that point in time. Are they what we would call PhDs, poor, hungry, and driven? Or are they in sort of wealth protection mode? Are they... So Marty, over the years, in the early years, was much more of a creature of the aggressive conservative investor mold. Over the years, he became what we call, let's make love, not war. Because typically one of the things you do, the sort of stuff we do, have done, we do currently, is focus on companies that are very asset rich. Our valuation methodology, because it focuses on the here and now, tends to be somewhat more balance sheet focused. It weighs the balance sheet more than the income statement. Why? To some degree, balance sheets are a snapshot of the here and now. You have a quick summation of the quantity of assets and liabilities, the quality of assets, the nature of liquidity on balance sheet, the nature of liquidity that's accessible to the company. And so it sort of is rather focused on the here and now in some sense. What we try not to do is to make big forecasts about the future. So why? I mean, I don't have a great crystal ball, very simply put. Macroeconomic forecasting as a basis for investing is pretty much not what we do, quite simply because I don't believe that one can, on a recurrent basis, again and again, to make repeatedly, sustainedly correct forecasts upon which you can hang your investments on. I mean, it's just way too big a risk of being wrong, and having your investments contingent on your macroeconomic forecasts of the future is not our forte. It's not what we do. It's not what we're capable of doing. That said, what is important, and it's particularly important for what we do and did then, is we invest across a number of different countries. We have to worry about things which relate to things like interest rates, inflation rates, exchange rates, all sorts of things. This has not historically been a concern at Third Avenue. So what evolved in terms of our own philosophy, how we thought about this, was, look, we will totally be bottom up in the way we invest. That's paramount, that's important. However, we will also think in terms of what happens if there's a sort of a serious macroeconomic shift. So at a given point in time, you have a snapshot of what the company does. The company's making money, these are the costs, and so on and so forth. Maybe they're losing money. But they're making, so this is what the company's business looks like at this point in time. What if there is a shift in things macroeconomic? How will this change the landscape for the company? Will the company be making big losses? Will the company's survival be threatened? So for example, I suppose this is really colored based upon my experiences investing outside the US, and we've seen all sorts of these crises, the Asian crisis that took place, the crisis that took place in Argentina, for example. I mean, many of these things were simple, so I wouldn't call them one-factor events, but they really were, the great driving factor behind these things was currency mismatches. Currency mismatches have sunk countries again and again and again and again. In '94 was Mexico, in 1998 much of Asia, East Asia and so forth. In 2008, I mean, you start to see stuff happening. I get ahead of myself here, but so the issue really is in terms of worrying about what sort of macro factors could really hurt the company. Hurt the company not just in terms of one period profitability, but threaten its viability as a business. So what you don't want, you really don't want to invest in a business which, by a simple shift in exchange rates, is going to jeopardize the company's existence. I mean, so you try to think in terms of a company vis-a-vis changes in things macroeconomic. Basically, think of it as a macro stress test. In the simplest terms, you do think of all sorts of things that cause you to, I don't want to say imagine, hopefully reasonably, within a reasonable, plausible band of outcomes, what would happen to the company if. And so that's where macro comes into the way we think about our businesses. Again, macro enters it the same way as things. Organizational, corporate governance, the political sensitivity of a business, and so on and so forth. We worry about those sorts of things. What could jeopardize the company's business? Just a very simple-minded thing. Pharmaceutical companies in developing countries. These often can be very profitable. However, pharmaceuticals in certain countries, notably India, for example, pharmaceuticals are believed to be a necessary good. Now, being a necessary good means it should be available at very modest prices. This, in turn, for many years led India to tweak its patent code such that you would never have product patents, but you'd never have product patents, but process patents. That is, if somebody else could come to the same end product by a different process, they could make it and sell it as a generic version of the same thing. Hence a very enormous scale generic industry in that country developed over the years. It was a very difficult place to do business. And so anything that is particularly politically sensitive, depending upon the country, for example, the US does not have any such thing, which is why you have the wonderful Valiants and Martin Shkreli's of the world. To the extent there's a necessary drug that can be tweaked up in prices here, you can do it in the US much more easily. It's a very sensitive thing in many countries. You just can't do it.